Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. As you probably know, the Federal Reserve yesterday lowered the Fed funds rate by 50 basis points. That was sort of big news. People expected it. I was a little surprised that it was 50 basis points rather than 25 basis points. And I'll tell you why in a minute. But what I thought I'd do in this short video is just sort of walk through what happened, some interesting comments that the Fed Chairman Powell made in response to a question yesterday when they announced this drop in the rates by 0.5%. And then more practically, what effect does it have on us, particularly those in or near retirement, and as we think both sort of long-term and short-term. So should we change our long-term portfolio? Long-time viewers probably know my answer to that's going to be a big no. But what about short-term cash? Should we do anything different? How's it going to affect all of that? So let's dive right in. I'll leave links to everything that I'm going to show you. This was just their statement yesterday, September 18th, 2024, where they lowered it, as I said, by 50 basis points. They're always targeting actually a 25 basis point range. So it's currently now 4 3/4 to 5%. This is sort of the overnight lending rate with the big banks and the Fed. It doesn't have any direct impact on us, but of course it has. Then there's cascading effects, and they can be quite significant. And let me just show you this. This is the prime rate, which a lot of different rates are set based on prime, and often it's prime plus or minus, depending on the loan, the terms of the loan. But you can see here, effective as of today, 8%. It was 8.5%. And of course, when the Fed lowers their rate, the prime goes down or up. In this case, it's gone down. It went from 8.50 to 8. So I can tell you, even in the credit card space, the interest rates on credit cards are going to come down, but so are interest rates on savings accounts. And so let's just take a look at what I've seen with the rates. First of all, this is just a long-term view going all the way back to 1954. Of the Fed fund effective rate, and you can see it was near zero, and then it started to creep up, and then we had the pandemic here, so they dropped it real quick to zero, effectively zero, and then it started to go up, and this is as of August. It's actually now, as I mentioned, dropped from what you see here by 50 basis points. But the surprise for me was that they went with 50 basis points instead of 25 basis points. And I don't pretend to have any special knowledge about what the Fed is going to do. But my sense was that, Powell has been a hawk on inflation. He said when he started to fight inflation, we're going to raise rates as high as we need to and for as long as we need to, because we are surely not going to have a repeat of the 1970s. And so I was a little surprised to see him raise it by 50 basis points. Of course, it's not just him, but the Fed. I think it wasn't a unanimous vote. I think there was one maybe that voted against it, but obviously it's more than just the chairman. But I thought, the economy is still doing pretty well. Unemployment's relatively low, and so I thought they might ease into it. What I read into the 50 basis point jump was that the Fed is more concerned about keeping us out of a recession than they are the potential inflationary effects of dropping by 50 basis points. Of course, the market expects they'll drop even more later this year and maybe into next year. I don't pretend to have any special knowledge on that either, but we'll see what they do. But certainly that seems to be where we're headed after several years of higher rates. Maybe now we're starting to see lower rates. Now, what does that mean as a practical matter? So I'll always look at this two ways. Long-term, my long-term portfolio, and then short-term, the cash that I'm holding either for emergencies or that I plan to spend over the next few months. Longtime viewers of this channel can probably predict I'm doing absolutely nothing different with my long-term portfolio. Haven't touched it. For me, I just stick with intermediate-term bonds, both sort of nominal bonds, both U.S. government and investment-grade corporate bonds, and then some tips. And I haven't touched it, and I don't plan to touch it. It's going to stay the same. For the short term, for cash, we are going to see interest rates fall, and we already have. I've already been notified by a number of savings banks with savings accounts and CDs that I track that say I've gotten several emails from these banks already saying, Rob, we're lowering our rates. due to what the Fed did yesterday. So that's going to happen. Let me just show you in the context of T-bills. We can look, let's see, it's right here. So this is the yield on T-bills. These are U.S. government bonds that mature in 52 weeks or less. And we can see this was at the beginning of the month. It was for the 4-week was at 5.25. This is through yesterday. Let me actually refresh. I don't know if we have today's rates. No, I guess they come at the close of the market, perhaps. Oh, here we go. They get updated at 3:30. But it's gone to 479. So that's a pretty big drop, 525 to 479. And you say, well, wait a minute. The Fed just lowered the rate yesterday. Why has it been dropping? Well, the market knew that this was happening. The market knows that this is the trend. And so we started to see changes in interest rates before yesterday. And in fact, you can look at all of them. You can go out to the 52-week out here. It started at 415. Now it's down to 381. We were at one point getting over 5%, I think, on all of these, or almost all of them. And I owned some T-bills that when I bought them, the yield was over 5%. But as you can see now, not a single one over 5. In fact, I guess 4.7. I guess we got a 4.80 here. But that's it. Now, I always compare these yields and interest rates on a savings account to inflation. And, we're still getting returns that exceed inflation, which is not the norm for cash. So in some ways, I'm still quite happy with these returns when I compare them to the inflation rate. And we can take a look at savings accounts. I'll leave links to all of this. We track a lot of savings accounts, and you can see this one's only guaranteed at that for 3 months. Although savings accounts aren't guaranteed at all, they can change any time, but that's one. You can see, though, that there are several still above 5%. But if you go to my site, I will leave a link to this. Double check the rates. I mean, we work hard to keep all these updated, but particularly when the Fed makes a move like this, sometimes we can lag behind a day or two. So let's just, we'll test one. Let's just see if Poppy Bank is still 550. If it'll come up here. There we go. Yeah, it is for the moment. Don't know how long, but that's the highest one we can find, and it's guaranteed for 3 months. So, in some ways, it's almost better than a 3-month no penalty CD. I don't know if there are any withdrawal restrictions on that account. You'll want to check the details. But that's what we're seeing. Savings accounts at the moment can still find some above 5%. We'll see how long that lasts. And for no penalty CDs, we can jump over to those real quick. We're seeing things near 5%. Yeah, there's one here for 507. That's for 4 months. And then they drop into the 4s. And again, I expect these to be moving down a bit. So you're going to want to make sure if you're going to get a savings account or a no penalty CD or whatever, just double check the terms to make sure they're correct, because I do expect a lot of these rates to be changing. So on the short term, though, for me, I'm sticking with two things. I'm sticking with the T-bills. I've already bought some. When they mature and the money comes back into my brokerage account, I'll buy them again. Yes, I won't get as good a yield as I have at the moment. If that were to happen today, I'd be somewhere in the mid to high 4s, I guess. And that's just the way the way it is. And I still own some money market funds that are still, again, I would say in the high 4s, maybe some still above 5. We'll see how long that lasts. I would expect that to be coming down. But for my money, particularly when you factor in taxes, I like T-bills because you don't pay state income tax. On money market funds, depending on the type, you might not pay state income tax, or if there are, I know Fidelity, for example, has a municipal money market fund. You don't pay federal income tax. And it just depends on your tax situation whether all of that makes sense. But for my money right now, I still like T-bills and money market funds for our short-term cash and sort of emergency funds. But again, there are, as I mentioned, savings accounts and no penalty CDs that are pretty good. The last thing I wanted to briefly mention was something that Powell said in response to a question that I found kind of interesting. Here it is. Again, I'll leave a link to this. So someone from, I guess it was Fox Business, asked him, hey, are we going to go back to the days of cheap money? So in other words, are we going to go back to these days here when we were at 0% or over here? And basically, Chairman Powell said, yeah, I don't think so. I don't know that that's going to happen. And he talks about what's called the neutral rate. And what that is what Fed fund rate can you get that sort of that sweet spot where the interest rates are not overheating the economy because they're too low, right? Or pulling it back too much because they're too high. It's like not too hot, not too cold, just right. Now, the challenge with getting that just right is that no one actually knows what that number is. It's trial and error, and it changes over time. But here's what he said in regard to that I found interesting. He said, right here, right here, I think it is. It feels to me that the neutral rate, right here, the neutral rate, again, doesn't overheat the economy or pull it back too much, is probably significantly higher than it was back then when we were at near 0%. I found that an interesting comment. Now, of course, there's no way to know if he's right. He doesn't know if he's right. That's his take on things right now as he's reading the tea leaves and all of the data that he undoubtedly has access to. But if he's correct about that, and it seems reasonable to me, for whatever that's worth, I think we're unlikely to go back to the sort of the 0% rates that we saw recently, and then even before that, really over the last decade. I mean, they rose a little bit at one point, but we were at 0% for a really long time. And of course, there were other government debt outside the U.S. that had a negative yield. And at least Powell doesn't think that's happening anytime soon. I guess time will tell. Seems to be reasonable to me. So I would expect to see interest rates come down more. How low they'll go, no idea. We'll just have to wait and see. Long term, though, I'm not changing anything about my investments. I will say it'll be interesting to see how this affects real estate. Obviously, mortgages have come down. I think I actually pulled them up at one point. I guess I don't have them here. Let me see if I can pull them up real quick, because they have been coming down as the market has realized, what's happening with interest rates. And in fact, I can show you the 30-year. I think, yeah, the Fed has this as well. And we'll go to just 1 year so we can see it. At one point, less than a year ago, 7.8%, 7.79. Of course, it dipped. It went back up a little bit, but we've really come down the last 3 months, I guess, 4 months. And at the moment, as of today, 609. And so it'll be interesting to see how that affects the real estate market. The one thing I'm kind of just out of interest is keeping an eye on is how low do the rates have to go before people that are enjoying 3% mortgages or even lower, but want to sort of move up and get a bigger home or whatever. How low do the rates have to get before they're willing to give up their fixed rate, low interest rate mortgage, so that we can put more supply out there, and how that would affect the price of real estate. Again, I don't have any predictions on that, but I do think at some point, as interest rates fall and if mortgage rates continue to fall, maybe it could loosen up the real estate market a bit, and be interesting to see what that does to home affordability. I guess time will tell. So, you may get to the end of this if you've been kind enough to watch the whole video and you're saying, Rob, so basically you're saying, yeah, the Fed lowered the rate by 50 basis points, but you're not really doing anything different whatsoever. Yeah, that's right. Nothing. And that's my go-to approach to investing for the most part, is to invest the same way, regardless of what the interest rates are doing. Maybe in extreme circumstances, I might make some changes here and there, but I've been in intermediate term bonds like forever, and I don't expect that to change anytime soon. So there you go. That's my take on what the Fed has done and the impact on rates. If you have any questions, leave them in the comments below. Be happy to help you out any way I can. Until next time, remember, the best thing money can buy is financial freedom.